I have worked as a financial number super user, as an equity analyst, but also as a number crunching accountant. This has given me a unique perspective. From the outset I thought double entry is too complicated and laborious. I remember talking to the head of audit about alternatives to double entry and he said you will just make another system as complicated. But I started with theory and the theories became algorithms and the algorithms became designs and finally code. In all it has taken me 10 years to carve out a new design. It was a slow process of chipping away at the old system and discovering the new. I stuck to the belief that accounting is an informational science, so information technology can transform accounting absolutely. Double entry is batch-based. Each month, quarter, yearly adjustments are added one on top of the other. Supporting schedules must be created. Forecasting is also batched with the need to create separate human resource plans, sales plans, CAPEX, and OPEX plans. And the budgets are quickly out of date. The problem, double entry is complex and not intuitive. Traditional accounting creates silos of financial information inside the finance department. Budgeting requires finance business partners to translate budget holders' expectations into a finance system. We don't need a special advisor on how to use Excel, for example, so why should we need them for accounting? The fragmented nature of accounting and complexity of the process of recording accountancy's adjustments means extensive and expensive audit. There are 3 different types of double entry: the invoices, payments, and the adjustments to the general ledger. Where the invoice income or expense spans across several reporting periods, adjustments are made in the general ledger, moving the invoice value from one reporting period to the next. These adjustments are checked for correctness, reconciled, using supporting schedules such as Excel. The payment date determines the order of the payment in the bank account. The purpose of bookkeeping is to resolve the issue of payments incoming and outgoing that falls into different reporting periods. The bookkeeping problem is one of timing. There is a very simple solution to all this complexity that I call a period entry. This single period entry encapsulates all the information in the invoice transaction, payment transaction, and the general ledger and supporting schedules. The best way to understanding a period entry is through a visualization against a timeline. The example here is an insurance contract that lasts 1 year with a work start date of the 1st of January and a work end date of the 31st of December. This is the blue line. The payment date is represented as an upturned triangle in black. In order to create a financial statement, we need to add a report period, the red line. The report period starts on the 1st of January and ends on 31st of March. And lasts 90 days. So here the blue line represents the life of the item and the red line the period of reporting of this item. We are interested in where the report red line crosses over the work blue. This crossed over portion of the work period is colored red. The crossed over portion represents the work done in the reporting period. It is 90 days and the work lasts 1 year, so the portion reported is 25%. The total value of work is £1,000. Therefore the work done in the reporting period is £250. For a customer this is an expense of £250 and the supplier with is an income of £250. The algorithm that calculates the crossover value is based on minimum and maximum calculations of the work start, work end and report start and report end dates. It calculates the proportion crossing over and multiplies that by the value of the transaction. The next thing to calculate is the amount paid. The logic here is that if the report end date is greater than the payment date report end date, then payment has been made. For example, the report end date is the 31st of March but the payment date is the 1st of January, then the payment is made and is equal to the total value of work in the period entry, which is £1,000. So we know the work done and the work paid for. The difference between these two numbers is crucial. It is your financial position. If a supplier has done work but has not yet been paid, the supplier is owed money and the customer owes money. If the supplier has done part of the work but has been paid in full already, the supplier owes work to the customer. In the following case, the first quarter's insurance has been received. This is 25% of the 12-month contract. It is worth £250. However, in January the entire year's worth of the insurance contract was paid. This means there is work outstanding. An advance of £750 has been paid by the customer to the supplier. In the next case, the first quarter's insurance has been received. This is 25% of the 12-month contract. It is worth £250. However, the entire year's worth of the insurance contract is paid in June after the reporting end date of March. This means again there is work outstanding. The customer owes £250 to the supplier. Any scenario of work and payment is possible. The double entry logic is adhered to: the financial performance, income or expense, and the financial position, profit and loss, payment and outstanding work, are calculated on the fly. There is no need for the general ledger or supporting schedules. The benefits of period entry is that it is easier to understand than double entry because it can be visualized. It is continuous in that it can be reported over any time period, be that a day, last 7 days, last 30 days, or last 365 days. It is single entry. There is no need for separate entries for forecasts and budgets. Double entry is backward-facing. Period entry is forward-facing. As it is based on work periods, these can be just rolled over. Period entry make compliance with accounting standards instant. There is a greatly reduced need for audit. As period entry is a continuous system, audit can become continuous with an audit team dropping in at any time. The audit would be just checking the periods on the period entries. This de-skills the work of an auditor. There can be multiple versions of a period entry. This means multiple bases for costing, the allocation to income and expense to a department or project. Consolidation is completely automated. In a large multinational, all of the transactions can be held in one database and intercompany transactions are instantly eliminated. The single database means the business can create accurate models of the business where a variance only matters where it changes the model. In conclusion, period entry is an accountancy revolution. It cuts cost of accountancy and audit by 90% and creates near-perfect information for companies.